Okay, let's dive in. Welcome back, everyone. This is where we take a whole stack of sources,
Mm.
articles, notes, research, and we try to cut through all the noise for you.
Yeah, find those important nuggets.
Exactly. Think of it as your shortcut to being really well informed, hopefully with some surprising facts, some insights that actually stick with you.
Mm-hmm.
So today, we're doing a deep dive into a really specific snapshot. We're looking at market and economic activity just from June 4th, 2025.
Just one day's worth of signals.
Right. And we've pulled this info from excerpts compiled in the Market Beat. Now, Market Beat itself gathers from tons of places. CNBC, CNN, Reuters, the Wall Street Journal, New York Times, BBC, lots of others.
A real cross-section of reporting.
Definitely. So our mission today is simple. Guide you through this specific batch of intel. We'll point out the key headlines, highlight maybe some surprising facts, and just try to make sense of what it all adds up to in that single day. And joining me to navigate all this complex data is our expert guide.
Ready to unpack it. What's immediately striking, looking at all this stuff just from June 4th, is the sheer contrast.
Contrast. How so?
Well, you see indicators pointing in completely opposite directions. It's really far from a simple single story coming through.
Absolutely. And that's exactly why these deep dives are so useful, right? The headlines alone rarely give you the whole picture.
Never do.
So, okay, let's kick off with the market recap from the day before, June 3rd. The sources show it was a positive day for the major indices.
Yeah, it looked pretty good on the surface.
The Dow gained about 214 points, which made it a 4-day winning streak. The S&P 500 and Nasdaq also climbed, both up over 0.5%.
Right. So like you said, on the surface, a solid day for the indices. But then you start digging into the individual company news, the economic data. That's where those conflicting signals really start to emerge.
Speaking of digging in, there was a pretty big movement right at the very top yesterday.
Ah, yes. The constant jockeying for the world's most valuable company spot. Nvidia made a move.
That's the one. The data compiled in MarketBeat indicates Nvidia, NVDA, it surpassed Microsoft, MSFT again, claimed the title of the world's most valuable company.
And the numbers are just staggering. We're talking market caps around, what, $3.45 trillion?
Yeah, $3.45 trillion cited.
Yeah.
And it's the first time Nvidia's held that top spot since earlier in the year.
And what's fascinating here, I think, is what that shift really represents. It's not just about the number itself. It really highlights the absolutely intense focus, the investment that's still pouring into artificial intelligence. Microsoft is a massive AI player, obviously, on the application side.
Sure.
But NVIDIA's core business, it's providing the fundamental hardware, the GPUs, right? The things that power all the AI development and deployment. So this valuation, it reflects where investors see the most, let's say, explosive foundational growth right now.
Okay, but here's where it gets really interesting and brings in one of those contradictions you mentioned. Let's look at Dollar General, DGG.
Okay.
Their shares popped yesterday. A massive 15% jump.
Wow, 15% for Dollar General. A discount retailer seeing that kind of move.
That is surprising.
Especially when the overall market's up, but maybe not screaming economic boom for everyone, right?
Exactly. The catalyst was their earnings report. They reported 2.4% same-store sales growth, and they actually raised their profit outlook for the year.
Okay, so higher sales, better outlook. That sounds unequivocally good on the surface.
It does. But the devil, as they say.
It is in the details. And these sources provided some key details. Specifically, CNN highlighted who was driving that sales growth, who was increasing traffic there.
And it wasn't just their traditional customer base.
No. They reported seeing more middle-income and even high-income shoppers coming in.
Okay, now that detail is significant. Why? Well, think about it. When you see consumers from higher income brackets, people typically less sensitive to price changes or, slight economic shifts starting to trade down.
To discount stores.
To discount stores, yeah, for essentials or maybe even some discretionary stuff. What does that really tell you about the current economic climate? It suggests maybe pressure, inflationary pressure, or just a general sense of uncertainty starting to bite higher up the income ladder.
Precisely. It's a data point that stands in really fascinating contrast to those rising stock indices we just talked about.
Yeah, it's like the Dow is saying one thing, but the shopping carts at Dollar General are whispering a different story.
Well put.
Okay, let's unpack another company making waves this time, definitely to the upside. Wells Fargo, WFC. Their shares gained over 3%.
And that gain is tied directly to a major regulatory event. This was reported across several sources. The Federal Reserve finally finally terminated that asset cap.
Ah, the big one. 7 years it was in place. $1.95 trillion asset cap from way back in 2018 after all those scandals.
That's the one. So this wasn't about, their recent performance. It was about removing a major historical constraint.
How significant was that cap, really?
Enormously significant. I mean, for 7 years, it basically put an artificial ceiling on their growth.
Right.
It limited how much their balance sheet could expand, limited their ability to grow lending, take deposits, essentially constrained their core business growth. Removing it, well, it lifts a major brake.
So analysts must be positive then.
Yeah. Analysts cited in the Wall Street Journal are already forecasting, moderate expansion. They're talking potential earnings per share growth maybe nearing 20% annually from 2026 to 2028, specifically because this cap is gone. It's a fundamental shift for Wells Fargo's growth path.
Okay, now for a company going the other way, and for kind of a surprising reason, CrowdStrike, CRWD. The sources show their shares tumbled 7% after earnings.
Yeah, and this is a great example of how specific operational issues, even slightly older ones, can ripple through. CrowdStrike's forecast, looking ahead, was weaker than expected for Q2 revenue, and they attributed that in part to the lingering fallout from a Windows outage.
An outage?
That happened last year, in 2024.
Wait, hang on. A Windows issue from last year is still impacting their revenue outlook now. How does that even work?
It sounds a bit strange, right? But according to reports, including one from Reuters, CrowdStrike expects about an $11 million revenue hit from a specific issue tied to that outage. And they expect it to persist for the rest of their fiscal year.
Wow.
It seems it affected their endpoint security offerings that are tied to Windows. It just really underscores how deeply interconnected these software ecosystems are and how disruptions can have much longer, more complex tails than you might initially think, even for a top cybersecurity firm.
Okay. Shifting gears a bit here, we also saw some political influence directly hitting a major tech company. President Trump is reportedly pushing back the national ban on TikTok. Again.
Yes, for the third time. This decision allows the app, which is owned by ByteDance, of course, to keep operating in the U.S., at least for now.
Is there a reason given? Or speculation?
Well, a New York Post source suggested this delay might be used as leverage in the ongoing trade negotiations between the U.S. and China.
Ah, so the fate of a massively popular app gets tangled up in high-stakes international trade policy.
It's a complex dance, definitely.
Meanwhile, switching continents, there's significant infrastructure investment happening overseas, and again, it's linked to that AI boom. Brookfield, bam, is planning a huge investment.
A very big one, $9.9 billion for a massive AI data center project over in Sweden.
Nearly $10 billion.
Yeah, that scale of investment really highlights the global race that's on to build out the necessary infrastructure for AI. Europe's clearly making big moves to bolster its capabilities, and a nearly $10 billion data center just underscores the sheer computational power, the physical footprint required to support advanced AI models. It shows the AI story isn't just a U.S. phenomenon.
Okay, let's look at the consumer health and wellness space. Peloton, PTON. They're trying something new, debuting an official resale marketplace for their used equipment, treadmills, and bikes.
This feels like a smart move for Peloton, maybe even a necessary one. The sources indicate it's aimed at tapping into that, already robust secondary market for their gear.
So instead of people selling peer-to-peer, Peloton gets involved.
Exactly. By creating their own platform, they can potentially capture some revenue from those resales, they can control the quality a bit better, and maybe most importantly, bring new users into the Peloton ecosystem at a lower price point.
Without the cost of making a brand new bike.
Right. It's about broadening their reach, finding new revenue streams beyond just selling new hardware.
Makes sense. Moving into corporate governance news from the sources, quite a statement at Warner Bros. Discovery, WBD. Over 59% of their shareholders voted against CEO David Zaslav's pay package.
Yeah, a $51.9 million package. That's a significant level of shareholder dissent, even though the vote itself, as reported by the Wall Street Journal, is non-binding.
So it doesn't force a change, but it sends a message.
Absolutely. It reflects that ongoing scrutiny of executive compensation, especially at a company that's gone through huge restructuring and faced, quite a few challenges. It's shareholders signaling pretty clearly about perceived value and what they think are appropriate pay levels.
Okay. More news hitting consumers directly. Capital One, COF, is tightening up the access rules for its airport lounges, starting in 2025.
Yeah, the New York Times reported on this. It involves increasing charges for additional cardholders and guests who want to use the lounges.
Why the change?
Well, it essentially brings their policy more in line with competitors like Amex and Chase, and it's largely seen as a response to, frankly, the growing problem of airport lounges overcrowding. It's a popular perk, so changes like this definitely get noticed by cardholders.
Yeah, I bet. Another area of concern highlighted in the sources was a string of cyber attacks hitting major retailers. Victoria's Secret, North Face, and Cartier were all targeted.
Right. Reports indicated these attacks led to customer data exposure and they also disrupted some online operations. The Wall Street Journal specifically noted that Victoria's Secret actually had to delay its earnings release.
Because of the attack.
Yeah, after a 3-day website crash following the attack, it's just another stark reminder of the constant evolving threat landscape for businesses and the very real operational and financial consequences when their digital side gets compromised.
Okay, let's check in on the auto market. This provided some really mixed signals, didn't it? Especially for Tesla, TSLA.
Extremely mixed. Looking at the sales data, May sales in Australia apparently saw this incredible surge, 675% month over month.
Whoa, 675%.
Yeah, driven largely by strong Model Y demand. But here's the catch. Year-to-date sales in Australia, still down 48%.
Okay, that's wild.
And then you look at other key markets, and the picture is weaker. China-made EV sales fell 15% year over year. Sales in Germany plunged 36% year over year.
Wow, those regional differences are massive. How do you even reconcile a 675% monthly jump in one place with steep year-over-year declines elsewhere?
It suggests very specific local factors are at play, right? Could be incentives, competition, maybe just delivery timing, batching. It's hard to say without digging deeper into each market.
Okay, how about Ford?
Ford had a much stronger May, at least in the U.S. market. They reported a pretty robust 16.3% year-over-year sales increase.
Solid. What was driving that?
What's particularly interesting here is what drove it. A huge 29% surge in hybrid sales.
Ah, hybrids, not full EVs.
Right. They also benefited from continuing employee pricing offers, probably trying to move metal amidst rising tariffs. But contrasting with Tesla, while Ford's total sales were up, their EV sales actually dropped 25%.
Down 25% for EVs.
Yeah, while their combustion engine models rose 17.2%. This data point really highlights that for Ford, right now in the current U.S. market, hybrid adoption seems to be the major growth story, not necessarily full EVs.
Interesting dynamic. And just a quick note on travel, Alaska Airlines, ALK, is launching its first ever route to Europe.
That's right. Starting next year, they plan to fly from Seattle to Rome. It's a strategic expansion, really leveraging those long-haul jets they picked up as part of the Hawaiian Airlines merger, entering a major transatlantic market for the first time.
Okay. Moving into the world of buyouts and M&A, we saw a significant deal in telehealth. Hims & Hers, Hims is acquiring a European telehealth platform called Zava.
Yep. Reports indicate this acquisition is going to substantially expand Hims & Hers' footprint in Europe. Adds markets like Ireland, France, Germany, boosts their customer base by about 50%, apparently.
So a clear geographic expansion play.
Definitely. Playing in that rapidly evolving telehealth sector.
And a large industrial merger was announced, too. Chart Industries, GTLS, and Flowserve FLS.
Right. These are manufacturers of specialized equipment flow control systems. They're merging in an all-stock deal valued at around $19 billion.
Big number. How did the market react?
Well, as often happens with these merger announcements, the market reaction was split. Chart Industries saw its stock rise over 2% in pre-market trading, while Flowserve's stock dipped about 1%. It's just the market pricing in the perceived synergies and the deal structure for each side.
Got it. Now let's pivot to some of those broader economic signals compiled from these sources, because this is really where those potential contradictions we hinted at earlier become most apparent.
Yeah, this is key. The May private sector payroll growth figures, they plummeted.
Plummeted how badly?
This is a critical data point, really caught attention. The private sector added just 37,000 jobs in May, according to the report.
Only 37,000. What was the forecast?
Forecast was 110,000, so a huge miss. It's the weakest number since March 2023. CNBC reported that this weak number immediately prompted President Trump to publicly urge Fed Chair Powell to cut interest rates. We report that neutrally, of course.
Right. But that's a stark contrast, isn't it?
Right.
Stock market indices up, Nvidia surging, Wells Fargo getting uncapped. But private job creation slows almost to a crawl.
It is a major disconnect. And there's also news about tariffs potentially impacting costs.
What's happening there?
U.S. tariffs on steel and aluminum imports effectively doubled today, up to 50%. The New York Times reported this move is sparking concerns, especially in industries like auto manufacturing and construction, about potentially rising material costs.
Even though the goal is domestic production.
Even though the stated goal is strengthening domestic production, yeah. It's another factor potentially adding to costs.
And the job market overall just seems to be sending incredibly mixed signals when you look at the details. You said private payrolls were weak, but official job openings actually rose in April.
They did, rose to 7.39 million, which defied expectations for a decline, and hires hit a 7-month high. However,
There's always a however.
CNN's sources also noted that layoffs surged in the same period by nearly 200,000.
Wait, so more job openings, more hires, and a big surge in layoffs all happening at the same time. That sounds volatile, counterintuitive.
It really does. Now, the openings to unemployed ratio did fall slightly, hit its lowest point since December 2021. That suggests the labor market might be cooling a bit from its peak tightness. But that combination, rising openings, rising hires, and rising layoffs, it suggests a significant amount of churn, potentially rapid restructuring happening within companies.
So not necessarily stable growth.
Exactly. Employers might be shedding workers in some areas while aggressively hiring for others. It paints a less stable picture than just looking at the total numbers. And it adds another layer of complexity to that economic stress signal we saw with Dollar General earlier.
Okay. How about the housing market? Mortgage demand reportedly fell again.
Yeah, for the third straight week. Even though average mortgage rates eased just slightly, down to 6.92%, overall demand dropped 3.9% last week.
Any breakdown within that?
Breaking it down, purchase applications were down week over week, but interestingly, they were actually up 18% compared to the same week last year.
Okay, so maybe some year-over-year improvement.
Potentially, but refinance activity declined. So it suggests potential buyers might be a bit more active compared to the depths of last year, but week to week, those higher rates, even with a slight dip, are still proving to be a significant hurdle.
Got it. And looking beyond the U.S., European business activity also showed signs of slowing in May.
It did. Reuters reported the Eurozone Composite PMI, that's a key gauge of economic health, it dipped to 50.2. That's barely indicating expansion. And services actually contracted for the first time since November. So, yeah, softening momentum across the euro area.
And Australia's economy missed forecasts as well.
That's right. Their first quarter GDP rose 1.3% year over year, but that fell short of the 1.5% forecast. Reports cited weak public spending and exports as key reasons for that slowdown. So you're seeing signals of slowing growth not just in the U.S. private sector, but in other major economies too.
But the sources also listed quite a few recent earnings reports that came out, showing it's not all doom and gloom, right? Companies like Hewlett-Packard Enterprise, Guidewire Software.
Health Equity, Asana, Thegor Industries, Signet Jewelers. Yeah, a whole list there. All reported revenue and earnings per share that actually beat analyst expectations.
Even CrowdStrike, despite the share tumble on the outlook, they beat on EPS, didn't they? Just a slight revenue miss.
That's correct. And it just reinforces that mixed picture we keep talking about. Even when the overall macro data suggests slowing, individual companies are still finding ways to execute effectively and exceed predictions. It reminds you that different sectors, specific businesses, they're experiencing very different realities right now.
And looking ahead just slightly, a couple of notable IPOs are expected later this week.
Yeah, Circle Internet Group, CRCL, the big stablecoin issuer, and Omada Health, OMDA, a virtual chronic care provider.
What does that signal?
Well, their ability to actually come to market, even if everyone's watching cautiously, it suggests that the IPO window isn't entirely slammed shut. Though obviously the market environment is a huge factor potential issuers are carefully considering.
Right. Finally, just a quick look at world news and politics that touches the economic landscape. A liberal candidate, Lee Jae-myung, won South Korea's presidential race.
Yes, marking a shift in political leadership there after a period of, well, significant turmoil, including an impeachment. Changes like this at the top can signal potential shifts in economic policy direction or priorities down the line, although the immediate impacts are often unclear and take time to unfold.
And back in the U.S., we saw a notable public disagreement within politics. Elon Musk criticizing President Trump's proposed multi-trillion-dollar tax and spending bill.
That's right. Musk reportedly called it a disgusting abomination and warned it would dramatically increase the U.S. deficit. This public rift really highlights the significant ongoing debate and, frankly, division over fiscal policy, even within the same political party as this major spending bill moves forward in the Senate. It's just a reminder that these high-level political battles have direct implications for the economic outlook.
Okay, wow. That was a remarkable amount of information and frankly contradiction packed into just a single day snapshot from these sources.
It truly is. We started with those headline market indices showing gains.
Right, Dow, S&P up.
Individual companies like Nvidia, Wells Fargo performing really strongly, driven by things like AI momentum or specific regulatory changes.
And even Dollar General, showing that surprising sales pop.
But then, as we dug deeper, we saw those significant red flags start waving. The alarmingly weak private payroll growth,
Only 37,000 jobs.
the surge in layoffs happening right alongside rising job openings and hires, that whole churn
Like
picture.
mortgage demand softening.
And those subtle signs of economic stress may be pushing even higher income shoppers towards discount stores.
Plus the increased tariffs, slowing signals in Europe and Australia.
Exactly. This collection of sources from June 4th, it isn't just a list of facts, it presents a truly fascinating juxtaposition. There are clear areas of strength and growth, especially linked to specific tech trends and corporate actions.
Yeah.
But these sit really uncomfortably next to data points from the labor market, from consumer behavior, that suggest some underlying fragility or at least uncertainty.
It absolutely underscores why you just can't rely on the top-line index numbers alone. The real story is in the details, it's in the contradictions, and how these different pieces of data relate to each other, even when they seem to be telling completely different stories.
Couldn't agree more.
So, okay, building on everything we've explored from these sources today, here's maybe a final thought for you, the listener, to consider. Given this really mixed bag, we saw strong market gains, specific company pops like Nvidia or even Dollar General, but then juxtaposed with that weak private payroll growth, increased layoffs, signals of economic stress hitting maybe even higher income shoppers. How might you interpret these different pieces?
Yeah, what's the takeaway?
Are they just temporary inconsistencies, noise in the data that'll smooth out eventually? Or do they point to something more fundamental? Maybe a shift in the economic narrative that's deeper than the headline numbers suggest, perhaps hinting at some turbulence brewing beneath the surface.
It's the key question, really.
Definitely something to keep exploring. Keep thinking about how these different pieces fit together, or maybe why they don't seem to fit right now.